We're going to have a look now at a more difficult example of cost volume profit analysis. We can see here Whelan Limited plans to sell 26,000 units, bringing in revenue of €1,040,000. Now remember from your CVP, one of the assumptions is that we sell all of our sales at a constant selling price. So if you divide that €1,040,000 by 26,000 units, you'll get a selling price per unit of €40. And we'll use that in our calculations in a moment. We can see our costs and expenses there, but as you know in CVP we've got to break those down into their fixed and variable elements. The question helpfully tells us that materials and direct labour are both variable costs. You really want to know that yourself. You needn't be told that, because you know that as we produce more or sell more units of output, sell more products, of course we have to have more purchases of materials and we have to spend more money on direct wages. So materials and labour will always be variable, will usually be variable costs. There'll certainly always be variable costs in these questions. The question tells us that our factory overheads are mixed costs. See there? In other words, they include both fixed and variable elements, and we'll come back to that in a moment. Our admin expenses and selling expenses, the question tells us, are all fixed except for a sales commission of 6% of sales. And if you get 6% of $1,040,000, that will give you 62,400. So we know that 62,400 of this figure here for the selling expenses, 62,400 out of that 87,900 is fixed, are variable. So the remainder of the 87,900 minus the 62,400 for sales commission will be fixed costs. Administration expenses are all fixed. And then we've got a bit of a challenge here to work out how much of the factory overheads are fixed and how much are variable. And the question helps us to solve that by giving us different production levels that they've engaged in the past and what the corresponding factory overheads were. So, for example, as we move from 13,800 units all the way up to 21,000, as we go from a low level of production to a high level, our factory overheads have gone up from 123,300 up to 148,500. Let's use that information now to break down the factory overheads into their two elements. So as we just said, at the low level of production of 13,800 units, our factory overheads were 123,300. And then when our production increased to 21,000, our factory overheads went up to 148,500. Remember now that as production increases, it's our variable costs typically that increase. So that 7,200 increase in production gave rise to an extra €25,200 in costs. They must be variable. So that gives a variable cost per unit of €3.50. So we're saying now that for production overheads, it's €3.50 per unit. And you can put that into any of these figures that they gave us here. Put $3.50 in there for the variable element of production costs and take it away from the total 148,500, and the answer you'll get will be your fixed costs. Again, what we're saying is We've established that the variable cost element of those overheads is €3.50 per unit. So take any of these levels of production, multiply by 350, and take your answer away from the total factory overheads, and you'll get your fixed overheads. And when we do that for our figures, we get fixed costs of €75,000 for factory overheads. No matter which of the levels of production we take, we are going to get the same answer. €75,000 will be the fixed cost element of our production overheads. Continuing our preparation here, we've said our selling price is €40 per unit. We're breaking down our costs into fixed and variable. We know our materials and labour are all variable. We've just worked out that the variable element of our factory overheads is €3.50 per unit. So €3.50 times 26,000 is 75,000. Is 91,300. 26,000 units multiplied by €3.50 will give us 91,000 in variable costs, leaving 75,000 of the 166 being fixed. We know all of our admin are fixed, and we've already said that our sales commission, or have we? Our sales commission is 6% of sales, which is 6% of €40 is €2.40 by 26,000 units, which is €62,400 in variable costs. So €62,400 of the 87,900 is variable, leaving 25,500 for fixed. This work here might take us about 5 to 8 minutes to work out all of this. And we have two key figures now. We've broken our costs down into fixed 216,000 and variable 738,400. We need variable costs per unit to do cost volume profit analysis correctly. So €738,400 divided by our 26,000 units will give us €28.40 for our variable costs, and as we said, our fixed costs are 216. So to remind ourselves, the key elements of cost volume profit analysis would be, what's our selling price? It's €40 per unit. How much of that has to go to cover the variable costs? We now know it's €28.40. So, taking our variable costs from selling price, we'll find out what's called our contribution, or our contribution margin. Every unit we sell for €40 covers the variable cost of €28.40, leaving €11.60 to spare, to contribute towards the fixed costs that come first. So, if each unit we sell at €40 contributes €11.60, how many units must we sell to cover €216,000 worth of fixed costs? Well, the answer would be the fixed costs divided by the contribution margin. The €216,000 divided by the 28.40. Sorry, correction. The €216,000 in fixed costs divided by the contribution margin of €11.60. And rounding it up, remember, rounding it up to the nearest whole number, we find that we'll break even at 18,621 units, and as we intend to sell 26,000 units, we'll exceed our break-even level by 7,379 units, and that of course is called our safety margin. We are 7,379 above a situation of making any loss. We're that safe. And every one of those 7,379 units contributes €11.60 towards our profit, which is 85,596. Comparing that with our figures up here, where we see 85,600 is our profit. That's what we're showing down here. So we're happy that we're on the right track. Answering the question, of course, break even is 18,621 units and the safety margin is 7,379. That's in units. If they ask us in value, don't forget to multiply by our selling price of €40. The third part of the question asks us what volume of sales, if we sell them at €45 each, will earn us a 15% profit percentage on the sales. Let's have a look at this now. We're increasing our selling price to €45. It was 40, so our selling price is going up by a fiver. Don't forget, our sales commission is 6%. So it was originally 6% of, our selling price is going up by a fiver, so our sales commission will go up by 6% of €5, which is 30 cents. So our original variable costs were $28.40. We have them there, $28.40, and now it's going up by an extra 30 cents to €28.70. So our selling price is going to be €45. Our variable costs have gone up to €28.70. Our fixed costs have stayed at $216,000. And they're telling us we want to make a profit of 15%. So let's check it out. Remind ourselves that sales is made up of the fixed costs plus all our variable costs plus our profit. Putting in as many of the figures as we can. We don't know the volume or the quantity of sales, so let's call it N, for example, or X, or whatever you like. So €45 per unit multiplied by the number of units N, that's our sales now, can be broken down into fixed costs. We know our fixed costs, €216,000, multiplied or plus our variable costs. Now we know our variable costs are €28.70. We got it up here, look. We know our variable costs are €28.70 per unit, N units, plus the profit. Now our sales is €45 N, so 15% of that is 6.75 N. Cancelling the euro by dividing across by a euro, and then bringing all our N's over to the one side, we have 45 N minus 28.7 N minus 6.75 N is equal to €216,000. So 9.55 N is €216,000, and that gives us an N value of 22,618 units. So if we can sell 22,618 units at €45 each, we will end up making a profit that will be equal to 15% of our sales. You can do a contribution income statement for that to check your answer if you have time in an exam. We'd be saying 22,618 units at €45 each will give us so much sales, less our variable costs of 22,618 units at $28.70 per unit. Work that out, take it away from your sales, that's your contribution, and then subtract your 216,000 in fixed costs, and you will get a level of net profit that is equal to 15% of your sales. Check it up if you've got the time. The next part of the question, part 4, is a typical sensitivity analysis question. We're going to tweak some of the figures and see what effect it has on our bottom line. Again, I prefer to do this per unit. Let's check out what it is they're telling us in this last part of the question. Calculate the profit Whelan would make if they reduced their selling price by 5%. Now, reducing selling price by 5%, it starts off at €40. Reducing it by 5% is reducing it by €2. So our selling price is going to go down by €2 to €38. Fixed costs are going to increase by 4%. So the 200 and what is it we have already for fixed costs? The €216,000 in fixed costs are going to increase by the percent they're telling us there, 4%. And we're changing our sales commission to 7%. Now, our original sales commission was €240. Now it's going to be 7% of a reduced price of €38. So now our sales commission, work it out for yourself, is going to be 7% of €38, which is €2.66. It was €2.40. So that means our sales commission is going up by 26 cents. So that means our variable costs are going up by 26 cents. And that's what we're using in our solution here, referred to as 4. Our selling price has gone from €40 to 38. Our variable costs that were 28.40 are now 28.66. That gives us a contribution margin of €9.34 per unit. Our fixed costs are no longer 216, but they've gone up by a percentage, gone up to 224,640. Remember, we said that the variable costs were going up by 4%, and if you get 104% of 216,000, you get 224,640. So now the question becomes, how many units do you have to sell, each contributing €9.34 to cover your €224,640 worth of fixed costs? And your answer, as always, fixed cost over contribution margin, is going to be 24,052 units. We are proposing to sell how many extra? Our sales units are going to go up by 20%. So we're going from, what was our original level of sales? 26,000. They're going up by that percent to 31,200. So we'll be 7,148 units beyond breaking even, and every one of those 7,148 units will contribute the contribution margin, €9.34 to profit. Our profit is always our contribution margin multiplied by our safety margin. Very often the question will ask you if you recommend this course of action, and the answer will always depend on whether you're making more or less profit. Our current circumstances, our current plan, is it? Or past tense, yeah. We made 85.6 in profit under our current situation, so there's really no point in making this change of lowering the selling price and doing all that if you end up with less profit. As is often the case, the very last part of the question concentrates on the theory. And this time they're asking us to explain what we mean by fixed costs. And of course, the last part of the question asks us to explain what we mean by stepped fixed costs. And you can see there in the graph. Fixed costs are costs that do not vary with the volume of production. Stepped fixed costs are those that remain constant over some level of production, and then they rise before continuing again at their new level. For example, in a factory, the level of production you have at the moment might require 1 or 2 supervisors or whatever it is. So therefore something like supervisors' wages would be a fixed cost. However, once you would reach a certain level of production and sales, in this case level X there in our graph, once you'd get to X, that level of production, beyond that level of production you have more employees, so therefore you might need an extra supervisor, so your supervisor's salary takes a step up and then continues along at that new high level for a period of time. Similarly, rent and depreciation would remain constant until the firm needs to increase production capacity. But then once you increase that capacity by having bigger premises and more machinery, you would then of course have more depreciation on premises, and you'd have more depreciation on machinery, so they'd step up and carry on at their new level. Stick with it, keep going.